the 1890s depression, the 1929 crash, the 1999 internet bubble, and 2007 GFC, and most recently 2019 and 2020's COVID crash. This cycle has predicted almost every single thing. And the most surprising part? It was published way back in 1875, so roughly 150 years ago. So someone from way back then had the foresight to predict every single major and minor crashes that were going to happen. Can you imagine? Can you imagine having all of this knowledge? If you knew this, you would have been able to plan all your investments for the next 50 to 100 years. For example, if you were able to follow this cycle, you would sell right before the top of 2007 GFC, buy again at 2009 lows, then you would sell again near 2019-2020 highs, and buy again around 2023 lows. You would have roughly 700% gain in the S&P 500. And of course, this cycle works for other stock market correlated assets too. So if you apply it to cryptos like Bitcoin and you start buying and selling them in 2017, you would get a return of up to 3,549%. And you might be wondering, what are the risks? Surely if something as good as this exists, everyone would become billionaires. And yes, you're right. There are reasons why not everyone are billionaires yet. So that's why in this video, I'm going to reveal what this cycle is. I'll then directly discuss the risk and reasons why not everyone are billionaires yet, so you know whether this video is a waste of your time or not. I'll also share with you how you can work around the risk to maximize your return, and lastly, I'll share how you can also apply this cycle to real estate. Firstly, let's go through what this cycle is really about and how you can benefit from it. So to begin this, I was going to tell the story of when I first invested into the S&P 500 with $1,000 in 2019 and lost all my money. And that if I knew that we were reaching the peak, I would have waited until the price dropped by X percentage in 2020 to invest back in, etc, etc. But the reality is, if you're just getting started, I would recommend just investing a small portion straight away regardless. Because time in market will help you learn when you're beginning. Because being on the sideline, while it might help you maximize your ROI, yes, but I reckon the learning and the experience you would have gained from being involved and being invested as a beginner is a lot more valuable than that. Since with that, you can understand the emotions that one person goes through and apply that experience to the next recession. But again, if you've been investing for a while, then working around the cycle timing is extremely important. And this cycle, especially, will help you maximize your return. So what is this cycle? This cycle is called the Banner cycle, and it was created in 1875 by a famous commodity forecaster named Samuel Banner, very well known for his predictions back in the 1800s. And you may have seen this very same graph that I'm showing here circulating on social media from time to time. Now the reason why this cycle is resurfacing again is because people are starting to see how scarily accurate it really is. The Banner cycle accurately predicted the 1890s depression, the 1902 crash, the 1910 panic, the 1929 Great Depression, and so on and so on and so on. And most recently, this chart showed a high into 2019 and a recession into 2023. That's not too bad considering that this forecast was made 150 years ago. So how does it work? Now when Banner created this graph, he was a believer that there was a pattern to time. He believed that the pattern followed a rule that did not change regardless of wars, panics, or elections. And to really uncover this cycle, he uses a collection of three main factors. Firstly, historical price data, so past pricing data. Secondly, weather patterns, so how the weather changes from year to year. And lastly, astrological phenomena, so things like the sun and the moon cycles and how that affects human biases. So through this, he created the cycle, and Banner made a name for himself as one of the most accurate economic forecasters of all time. He was so good that even Edward R. Dewey, the director of the Foundation of the Study of Cycles, analyzed his forecast over a 60-year period and called it the most notable forecast of prices in existence. So with that, how do you actually read the cycle? So if you look at the cycle right here, there are three main horizontal lines: line A, line B, and line C. Now line A, the top line, it reads years in which panics have occurred and will occur again. So this indicates major market peaks that have severe economic impacts affecting all markets, including the stock market and also the real estate markets. The line B, so the middle line, reads years of good times, high prices, and the time to sell stocks and values of all kinds. Now this usually talks about the milder peaks and crashes, often a result of overvalued stock markets. And these crashes tend to be financial crashes only and don't hurt the economy as much as line A. And both line A and line B are a good time to sell and reserve your capital for when the market hits the bottom, which is line C down here. Now this line C, so the bottom line, it reads years of hard times, low prices, and a good time to buy stocks, corner lots, goods, etc., and hold till the boom reaches the years of good time, then unload. Now that's pretty self-explanatory. This line indicates a suitable time for you to buy at a low price. Now let's discuss the risk with the banner cycle and really find out, if this cycle is so good, how come everyone haven't become billionaires using this cycle? Now firstly, the reason why you haven't heard of a lot of people becoming ultra rich and sharing this cycle is because it's not very well known, so it's not yet popularized. Also, like every prediction model, this one has a margin of error for its accuracy. This applies primarily in terms of picking tops in the stock market. A lot of times, the forecasts from the banner cycles are a year too early or too late. However, it did accurately predict the 1890s depression, the 1902 panic, the 1910 panic, the 1929 Great Depression, and so on and so on and so on. And most recently, it showed a high into 2019 and a recession into 2023. So that's not too bad, considering that it made this prediction 150 years ago. It also gives a warning of the next recession in 2026, which correlates with the land cycle peaking with a declining trend into the early 30s. So overall, I do think if you do take into consideration the small margin of error and include it into your long-term investment plans, you still can make a big chunk of money even if you're a year early. Now I personally combine this with my other reliable indicators to minimize this margin of error. So technical indicators such as the Shiller PE ratio, the total debt to GDP ratio, yield curve inversion, and herd mentality indicators such as my aunts from back in Vietnam. Now this one is my personal favorite and the most reliable one thus far, and it usually comes around 5 months away from the crash. Alright, let's go through each one briefly. Now the Shiller PE ratio measures how overvalued or undervalued a market is. It's calculated using the market value of the S&P 500 index and dividing that over their average earnings. Now currently we're at a PE ratio of 38.61. Now I would say this is something to worry about because the previous 2021 high was 38.58 before the crash, and the 1999 internet bubble was at 43.31. So I would say if we get anywhere near the 40s zone, I would be slowly unloading my holdings. But of course, you need to integrate this with other indicators as well. So one being the total debt to GDP. Now this measures the total debt a country has over its GDP. Now total debt here includes household debt, private debt, and public debt. A high debt to GDP ratio indicates how leveraged up a country actually is. So the higher the leverage, the more likely the country's economy is going to crash. Now you will notice that I'll be talking about the US mainly for now, since Australia tends to follow the US cycle and seems more dependent on the US market performance. Currently, we're at 270% total debt to GDP. And this number, in my opinion, is pretty high. Especially when you look back in 1999, it was only 260% of GDP, and in 2007, 350% of GDP. So according to best practices mentioned by Ray Dalio, the founder of the world's largest hedge fund, Bridgewater Associates, you should start unloading around the 300% total debt to GDP mark. Now the third indicator you should also look into is the yield inversion curve, which details the short-term to long-term yield. If the yield curve starts to go from flat to inverted, it's a very strong sign that the market is about to fall within the next 8 to 12 months, and this one has been extremely accurate. Since 1955 actually, every single US recession has been preceded by a yield curve inversion. Now currently the yield curve has gone from inverted to flat after our last recession. However, the next time the US government raises its short-term rate and inverting the yield curve is a sign to again slowly unload your holdings. And lastly, my favorite indicator and the most reliable one thus far with an 100% hit rate, the Aunties indicator. Now what is the Aunties indicator? Okay, so I have a few aunties back home in Vietnam, and every time I come back, I would eavesdrop their conversations, yeah? Why? Because every single time I hear them talking about investing into the stock market or crypto, it would be exactly 8 months from the crash. And it's been happening 3 times now, and it's helped me sell my positions at an extremely good time, earning me hundreds of thousands of dollars. So if you do have some aunties at home who love to talk and jump on new things, make the best use of it. Now, let's see how the banner cycle has changed over the years as we gather more data. So to really see how the cycle has changed, let's look into a cycle very akin or very similar to the banner cycle, the 18.6-year real estate cycle. It's one of the cycles that Banner used in formulating his work. Now, I want to look into this cycle because unlike the Banner cycle, which has not been updated in the last 150 years to accommodate new data like wars, the 18.6-year real estate cycle founder Fred Harrison is very much still alive, and there's a whole team behind him working to always keeping the forecasting cycle up to date. Now with the 18.6-year real estate cycle, there are 2 market peaks, one being the mid-cycle peak, the other one being the end-of-cycle peak. Now first one, the mid-cycle recession or mid-cycle peak is driven primarily by an overheated stock market, while the end-of-cycle recession is a land-driven recession. Since land has people from all over the world, so all income brackets involved, while stocks are primarily owned by the top 1%, a land-driven or an end-of-cycle recession is a lot more severe because it includes everyone. So when you bring the same concept over to Banner's cycle, you can see from the start, so row A marks the peak of the real estate cycle, so the end-of-cycle recession, while row B, the middle one, is the mid-cycle recession, so the less severe one. However, interestingly, according to new data from the 18.6-year real estate cycle, once you get to the Second World War, so 1945 war, the end-of-cycle peak switches from row A to row B. So in other words, after the Second World War, row A is now actually the mid-cycle recessionary point, so the less extreme one, and row B has now changed. It's now the end-of-cycle peak, so the more extreme and the land-driven recession. So therefore, we can see and we can say that the Second World War actually switched the timing of the final peak with the mid-cycle peak. It has interrupted the rhythm of the boom and the bust. Now, why did it do that? This is because war policies can easily stop booms and busts in the land market due to the government changing their resource allocation, their government spending, and their economic priorities. So that's why it's very important to keep yourself up to date with data. This will help you understand when there will be a big change in market momentums or cycles. Now looking at the dates on the Banner chart here, you can see that row B is marking the next end of cycle real estate peak as of 2026. Now knowing that the Banner cycle can be 1 year off and basing off from our other mentioned indicators, we're looking at a market peak around end of 2026 and mid 2027. So this should give you a good time frame to slowly reduce your position as we get near to that future.